Welcome to Northwest Arkansas Investing Podcast, your go-to source for real estate investing in Northwest Arkansas.
Whether you're a seasoned investor just starting out, we bring you expert insights, market trends, and practical strategies to help you build wealth through real estate.
From buying and selling to property management and long-term investment planning, we cover it all so you can make smart, informed decisions in this fast-growing market. Let's dive in. All right, welcome back to Northwest Arkansas Investing Podcast. I've got our co-hosts Brian Wagers and Zach Stanley. And we've got our special guest, Mr. Rocky Feinberg. Thanks for coming, Rocky.
Of course.
Flew in from Nashville. Yeah. And so we're pumped to have him. He's kind of got a wealth of knowledge in his businesses in private money. And so we'd love to give us a 30,000 foot view, Rocky, of kind of your story, what your business is like, where you're from, whatever. Would love kind of everybody to get to know you a little bit.
Of course, man. Thank you guys for having me. Pleasure to be here. First time in Northwest Arkansas.
Glad you're here.
Yes, sir. Beautiful place, man.
It's awesome.
Yeah. I went to school in Tuscaloosa, but don't hold that against me. Drove by your campus today. Beautiful place.
Yeah.
Actually, initially, funny enough, I started in the music industry.
Really?
It's like pretty crazy. Yeah, I was like one of those guys that came up watching the TV show Entourage, and I'm like, I would do that. Which it actually was. I worked in the mailroom at CAA, which is a massive talent agency in LA. Quickly, got promoted there. I was working the music side and took a job out of Nashville. Did that for a couple of years right before COVID. I was like really tired of just like grinding for $37,000 a year and getting a 25-cent an hour raise a year. And I'm like, there's got to be something more than this.
Yeah.
Talked to some friends who I used to look into real estate, and long story short, got my license actually as a broker. Went to go do investment sales with a local guy who left Colliers in Nashville, started his own firm, learned a lot under him. And, it was good and I liked it. I liked the commercial side of it, but I was more interested in the kind of the financial side of it. And I got plugged in with a guy who was helping a company from Los Angeles break into the Southeast market. And the company was named Civic Financial Services. Did traditional single family loans on the investment side, fix and flip, no ground up actually at that time, DSCR type stuff. And that was kind of my intro into this space. And I worked with them for, I'm going to say 3 or 4 years, something like that. Long story there. There was a manager buyout with the bank that owned us. Things kind of went south with that company. Yeah. A lot of people were, on the rocks, potentially leaving. And I was actually going to go back into commercial real estate and go do debt and equity. And I was grabbing a drink with a colleague who had a similar company in Nashville. And I was like, we're starting something. Little did I know they've actually had the company for 2 years, which is where I'm at now, Windstone Private Lending. I'm executive vice president of that company. And he's like, we're kind of just playing around with it. We don't really know what we're doing. And, we have some loans on the books, but we're not paying enough attention to it. And went and started working with them. We found a niche in the market. And to me, coming from, and I think it was really important for whoever took over this company to try to grow it, that they came from the background that I did with a more institutionalized company.
Absolutely.
Yeah.
Because like every single day, and I'm sure everyone listening and you guys have dealt with it, where you're getting financing and it's like, man, this is actually harder than doing the project itself.
Yeah.
Day before close, another bank statement, a letter of explanation, underwriter giving you issues with one or this, and that. It's like, this was just so eye-opening to me. It's like, well, this kind of financing exists. Obviously, it's a little different than what's out on the market, but we're able to grow the business very, very quickly. We entered into some new markets, partnered with some guys, and, kind of just naturally kept building from there. We're 2 years in since when I joined, and we've 10x'd the company in that time.
Incredible.
4 employees, now we're at 18.
That's awesome.
And we want to keep the track record going and continue to do well for our clients, provide a good service. Yeah.
What markets so far have you guys entered into?
Right now, we are in, I guess, technically north to south and the southeast. We're in Columbus, Ohio, Indianapolis, Indiana, Lexington, Kentucky, Louisville, Kentucky, Bowling Green, Kentucky, northern Alabama, so kind of that Huntsville area, Mobile, Alabama, which is one of the new ones we popped into. Upstate Greenville, South Carolina. North Carolina, we're in Charlotte, Raleigh, Durham, Fayetteville, kind of every big market there outside of Wilmington, and Asheville, North Carolina.
Right. Man, what took you so long to get here?
Well, it's funny. Part of what we do is, it's not really a science. we can follow population trends as much as we want. We can follow where the money's moving, days on market, all these different activities to give us indication of where we should go lend our money. Because we want to be like, every big company, like big box, private lending company or hard money, whatever you want to call it, they love doing business in Miami and Dallas and Austin and LA and Scottsdale and all these places. Like, it's great. You got $1 million deals there all day, and you can't get enough of them. We take a little different approach. We want to be in markets that are on the move. So like a lot of the markets I just mentioned, similar to y'all, have seen a massive surge since 2020.
Yeah.
Obviously, induced by COVID and the COVID flight of people moving from market to market, leaving the LAs and the Chicagos and the New Jerseys and New Yorks to come to these markets, for workability because they could work from home, cost of living, all that stuff. But we look at it from that approach, and like, there's real no science behind it. I look at commercial changes too. I think your state's politicians have done a phenomenal job getting companies to move here with tax breaks and stuff like that. Brings more people here, increasing home prices, more commercial development. Driving around here today, I'm like, I'll pay you $1,000. You can find a building that's older than 10 years old here. It just shows the growth. So I'd say that's probably the main reason we decide to move into markets is, I follow a lot of trends. Like, you can follow Topgolf. Like, if somebody has no idea what they're doing, pick out one company, say Topgolf is where
Whole Foods, Topgolf.
I'm going to follow you. Every market you go to, I'm going to go to as well. They pay hundreds of thousands of dollars a year on analysts to find reasons to go to these markets. You could just search Topgolf new locations and development. It's a great
start going there.
It's there's no real size to it. At least for us, we say, looks good. And then we look at the housing trends and days on market and stuff like that. And make our decision from there.
I feel like that's when we finally thought that we made it, is when we got like a Topgolf, or when we got
we did it.
We still don't have like the Costco's and stuff, but Walmart's really pushing those out probably. But
sure.
But anyway,
I like how you're looking at them. You're looking at emerging markets, and we're talking. We talk a lot about Northwest Arkansas, and within Northwest Arkansas, there's emerging markets like Centerton, Pea Ridge, Bella Vista, and how you guys look at it. Northwest Arkansas is still you're coming from Nashville. You're overlooking the big cities that have already emerged, and to someone in Northwest Arkansas, we still have people viewing Northwest Arkansas as an emerging market. We think, oh man, it's gone up so much, but there's still a lot of outside capital, a lot of outside institutionals coming to the area. And I think that's such a good point on the different factors too you're looking at emerging. What other companies are investing money? We talk about Starbucks in the past. It's probably good if you're buying an A-class apartment. It's probably good if there's a Starbucks or a Whole Foods right next to your apartment.
Sure.
So I think that's
those things have to matter. And I think from like a more holistic approach too, when you're looking at it, it's you have to compare it to other towns as well. Like, for some reason, I don't know why I put these two together, but if I look at Greenville, South Carolina, 15 years ago, I'm privy to the area. I've been there, grown up. I had family there, so I've seen the transgression of it.
Right.
This is so eerily similar to it. And when you think you're like, wow, we made it, you have no idea how much further that can go. It's crazy to see. Like, we see it in Nashville. I was talking to somebody last night about this. It's 2014, 2015 is kind of when things started to really, really build there. And one of the neighborhoods that in 2005, you wouldn't walk in past 6 o'clock. The tear down in that neighborhood now goes for $1 million.
Wow.
That's great.
And it's, and I'll talk to my friends there about like, God, do you think this is a good buy? Is this a good buy? I'm like, I can't tell you. I have absolutely no idea, because this thing could be triple what it is in 10 years. It could stay stagnant. One other thing that's, I think, important to mention about emerging markets too, in comparison to those other big markets we talked about, is from a risk standpoint for investors. So we just saw over the past 2 years, it's no surprise to anyone listening, we saw a minor price adjustment in the market, obviously influenced by rates and other external factors, now even tariffs with the cost of construction.
Feeling that?
Yeah, I'm sure everyone is, and it's a real thing, but there's a bigger hurt to those bigger economies, those bigger cities, in price adjustments than there are to emerging markets.
Yeah,
definitely.
And so it's a great way to hedge risk too. So when I look at it, I think I read something about Northwestern Arkansas where you guys maybe had a 2.5% decline in home values or something like that over the past year and a half, just completely natural when rates double, right? Be looking at a market like Austin, Texas, who's down almost 20% home values. You look at LA, who was closer to the average of the United States was like 10% market deduction. Nashville, same 10% market deduction. But you guys are only at 2.5.
Yep.
And there's something to say about it. And a majority of the other markets we lend it are the same exact way.
People freak out when it only increases like 1 or 2% here. Like we're
right.
Like, look at these other markets. It's like, no, it's going the other way.
Yeah.
Right. Yeah. And it's so you got to be very careful about that stuff. People get in really excited. They get really excited. Like, I mean, you see people, I'm not a crypto guy. I'll never claim to be one, but everyone's like, you got to go buy this coin. You got to go buy this coin. You got to go buy this coin. You wake up in the morning and 75% of your money's gone. It's like, whoa, what just happened here?
Yeah.
This is very slow, steady. It's like, it's like investing in the S&P, just slow and steady. There might be a little, wiggle room here and there, but ultimately, it's a safer place to put your money in long term too. You can see great growth.
Yeah, absolutely. I think that's something that we see a lot of, and even us guys that have been around here for so long. Zach and I grew up here. Brian's from Cincinnati, but has been here a long time. We see that even though all this growth has happened and everything's doubled or more, what the end looks like maybe in 20 years, and especially a lot of that driven by population growth and what they're projecting there. So we love kind of what that looks like.
What I love about this area, and I've actually had this conversation 4 or 5 times, and I think you guys will concur with it, is that I think with the local government, we have really big buy-in from our big money people, from the Waltons, from the Hunts, from the Tysons. And so when an area needs some help in development where local government doesn't have it, like we might have a Walton go, here's this money, go take care of the infrastructure. And so we have this buy-in from generations of billionaires that are like, we love this area. And so it feels unique for us where we have I think the stat is 9 of America's top 20 wealthiest people live in Northwest Arkansas, like the corn, drive your tractor state, in Northwest Arkansas, they're here. And so I love the local buy-in we have from people like that. Something I also want to touch on is Rocky was saying that they're going into all these markets, and a listener listening, we'll get into y'all's products and you a little bit more, but you don't do any marketing, which I think is super cool. No. And so the stuff you're pushing must be good. And so I would say to keep tuning in for what he has to say about that. I mean, doing no marketing, coming into these big markets and being successful over and over and over again speaks volumes for your company and for what the stuff you guys have been doing.
Yeah,
absolutely.
Yeah, it's exciting to see. You plant a couple seeds everywhere, and they start to grow. And it's not even about the money; it's more about working with the right people.
Yeah.
Providing good service. If you start taking on too much business at one time, you lose your edge.
Yeah,
really quickly.
Absolutely.
Yeah.
Rocky, we'd love to get more of an idea for folks that don't know anything about what you talked about before and what your business does. Private money. What is that? Can you help explain what that looks like?
Yeah. I'm 5 years old. Tell me what that means.
Give us an idea of different products and maybe how others have used you in the past, stuff like that.
Sure. So I'll first explain different kinds of financing you could have as an investor. I'm just going to use the terms that I think are industry standard.
Yeah.
A lot of people disagree with me on these terms. That is fine. As long as you allude to what you're talking about, it's all that matters.
Right.
So the main source of financing that there always has been traditional bank financing. We all know what it is. You buy a house, you use it. You get a car finance unless you get a credit union. That is what you use. That is pretty much the banking and global economy, right? So you do a fix and flip. They will do new construction, fix and flips, DSCR, all those types of loans.
Yep.
You can get a loan through them if that is your objective. Only difference is it is more of a borrower-based underwrite rather than an asset-based underwrite. They care about your debt to income, your global cash flow, all these items, as well as the property itself. But it's a bureaucratic process. I've been through it. I'm sure you guys have gone through it.
Yes.
Full appraisals, hard credit checks, this, that. It's a lot, but it's going to be some very cheap financing. Yeah. If you're willing to jump through the hoops and put down a ton of money and waste some time, it is your best financing through and through.
Yeah.
Off of that is kind of where this hard money realm came.
Yeah.
So hard money is like, they have a great product over here. However, you're asking for a lot. When we finance these deals, we don't care as much about you. We care more about the property because we have to take this back. You're not going to help us out. Yeah. This is the only tangible asset we have.
Yeah.
So it's very similar. The only difference I'd say is obviously they care more about the property. If a bank has 15 to 20 credit boxes that they need to hit, the hard money company may have 5 to 10, but it's still a bureaucratic process. You're still getting an appraisal. You're still doing a construction feasibility study. You're still jumping through these natural banking hoops per se to get the deal done. Trade-off, slightly more expensive on price. So that's kind of hard money in general. You're still putting down, 10 to 20%, going through a hard underwrite, getting a full appraisal, doing the construction draws the natural way, maybe 1 to 3% higher on origination or rate with those guys. The other kind of financing, well, I guess there's two parts to this, is there's private financing. Private lending, what I do, what a lot of other people do. There's two types of private lending that can get confused. The first part is if you have a rich uncle, rich family friend, rich somebody who's going to be like, hey, I got money, I want to lend it to you. Here's 10%. I might not even record a deed on this. Yeah. That is hands down the best financing you'll ever get. Yeah. Like if you have that, I would never try to sell somebody my product that has that. I'd be like, you know what? That is a phenomenal thing you have there. Run with it. Right. That is private lending through and through. That's not the private lending that everyone knows about because not everyone has that. The private lending that I offer and that majority of market offers is we raise money, we lend that money with our own rules. So the hard money companies, 90% of them, what they do is they have 3 to 4 note buyers on Wall Street or other places that essentially say we need this minimum credit score, this maximum loan amount, this minimum loan amount. Construction can't be more than 75% of the cost of the purchase. Like there's all these little credit boxes. So that loan originator will essentially have to get that loan and find which box it fits in. Once they get enough of those loans, they package it up, they sell it off to the partner. They don't balance sheet the loans. So they're essentially an intermediary to the final buyer of the loan. What a private lender does is they balance sheet everything, but they play by their own rules. Some days we wake up and we say, no minimum credit score, which we don't have a minimum credit score, but we say we're willing to do new construction. The next day, no more new construction. But somebody could come to us with a commercial property, be like, that's a pretty good deal. We'll take a look at that. We don't have any guidelines. We don't need any certain kind of documentation. We choose what we want to need and that's it. Inherently, that means we could also do other items like not have to order appraisals. We don't need to do hard credit checks. We don't need to do on-site inspections for draws. We can close in 1 to 2 business days. Does that for y'all on your end, does that require a lot, maybe not underwriting on the deal, but underwriting on the trust process of who the person is? Sure. Relationships have a massive part of it. If you have a track record with us, that speaks volumes. We have people that come to us all the time. They're like, I've done 20 deals, this, that. Yeah, great. Yeah. I would probably rather partner with the guy who's done 2 with me and paid them both off in time and didn't miss a payment. Yeah. Just because I've worked with him. I've seen his stuff. Institutional knowledge. Probably phenomenal. I'd love the opportunity to earn your business. However, relationships carry a lot of weight. I mean, we've in Huntsville, Alabama, we work with this guy all the time down there, and he's like, I have an industrial deal I want to do. Like, we don't do industrial, but you've successfully paid off 30 deals with us. So maybe we should look at this, and we did, and we financed it. And it was great. And he paid us off and everything was good. But, if somebody came off the street, it'd be like, let's get a couple, let's get a couple easy ones, a couple base hits and we'll go from there. The products that we offer, I think was the latter part of that question. I would say typically short-term construction loans. We can do short-term bridge loans, but we're looking traditionally fix and flips, BRRRR deals, easy new construction deals, 3-bed, 2-bath, 12 to 1,800 square foot type new construction deals. I don't love multifamily, I'll be honest. 2 to 4 units we'll look at. We've financed plenty of them. Once you get over 4 units, the takeout partner gets a little more difficult on who will refinance those or who will buy those. The only reason we say that is with a single family, your buyer pool is like this big. With multifamily, it's like that big. So it's razor thin on the risk side.
I'll see myself out.
I will say I know plenty of lenders who will handle those deals, and I'm happy to refer anybody even listening to this who may need a lender to do that. It's just personally not me. But sometimes we do get a deal where it's 18 units and we'll take a look at it and we'll say, this is interesting. The numbers make a ton of sense. We'd prefer that sponsor has a significant, degree of knowledge of multifamily. We get, because there's a natural change. You'll kind of see a lot of people, they hop in with wholesaling, then they do fix and flips for a while, then they do some BRRRRs and they're like, I want to do new construction. Like, multifamily, industrial, which is great. And I completely implore that. Sometimes people just go a little too fast. They try to go from like wholesaling to 134 unit apartment complex in Hawaii.
Yeah.
How did I get here? And it's like, hey, best of luck to you. I'm just not the partner for you on that deal. If you ever need any advice, give me a call. But I just really can't do that.
Brian, I know that as far as exit strategy goes, here's the conversation I'll have with my clients, but the investors that come to me out of state, and I'm representing a lot of people in single family and small multifamily. And I'll go, hey guys, I know, we're talking about 18 plus units or, 4 plus units. Everyone talks about entry. No one thinks about exit. And so I'll go, the person who's going to make that emotional decision on a single family is a lot bigger. And so that person can go, yeah, this is our home. It doesn't have to make mass sense. It can just make sense for my heart. And like that single family, or maybe that duplex, it's a little in the emotional field, but like the 18 plus. Now there's great, as you know, there's great ways to exit big multifamily as well. Brian does syndication type stuff.
Smaller multifamily. Yeah. Just some of the 18 units, 20 units development. Yeah. And some syndication.
Well, there's a massive need for those.
On a lower level, like for your average person, it's a lot easier to exit those single families, those multifamilies like that.
Right. And I think, what's kind of scary too is, we could get into this later, but you talk to somebody doing the deal, maybe even be their first deal. And it's like, well, I'm going to sell for $400K. It's like, what if it doesn't sell for $400K?
Haven't thought past that.
Probably think about that. Yeah. And I'm sure we'll probably get into that stuff later on in the show.
Yeah.
It's a question you should always ask yourself if you're getting involved with the deal. Your lender should ask you that too, because, I'm not here to just make money. Obviously, we run a business. Our goal is to make money, but we're also trying to provide a service. If you get a double bogey on your first deal, you're likely not coming back for another, which means we can't do more business together. There's plenty of times we'll tell clients, like, I understand you like this deal. I understand this is what your wholesaler is telling you. This is not a good deal. This is not personal. This is numbers.
Yeah.
It's at the end of the day, what we do is completely statistical and based with data.
Yeah.
Here are the numbers. Can you potentially get that price? Yes. Will you likely get that price? None of this data is telling me.
Yeah.
It's not emotional. People, you don't get it. You don't understand. I'm like, sorry.
It sounds like a lot of your bread and butter though is fix and flips, kind of, deals that guys are trying to get a quick hit on, really.
Yeah. I mean, or the burst stuff is very circumstantial. But a lot of it's fix and flip. I think, right now, even we're kind of nearing back slightly towards a buyer's market. I think it's pretty even playing field, but people are like, oh, it's just not a good time to buy for fix and flip. It's not a good time for this. One, I don't care what rates are at. There's always a good time to buy.
Yeah, absolutely.
The price is everything.
Yeah.
It's whether or not you're buying for the right price or not. So it's like, rates could be 10%. This could be 2020 when the market was going crazy, or it could be 2023 in March when stuff started to increase. There's always a good time to buy. It just depends the price you're buying at. The way we envision it is, fix and flips, especially for people that are trying to retain a lot of cash and keep things moving, are a phenomenal way to do it. Burrs are too. If you would have asked me in 2022 what the best route I'd say is probably burrs.
Yeah.
We were seeing guys buy properties for 150K, put in 50K to them, and they'd appraise for 325,000. They'd do 80% cash out refis, and they'd be debt servicing, and they'd walk with a $70,000 check in a debt servicing proproperty. It was like, it was unbelievable to see this. Yeah. I financed two 21-year-olds out of California who I think they had a working capital stack of over $1.2 million. They did this in San Antonio.
Nuts.
They dropped out of college to do this. It was unbelievable.
That's crazy.
One day they go, the music stopped.
Yeah.
So being hyper aware of stuff like that and realizing there's still a ton of money to be made in real estate, whether it's 08 or whether it's right now. You just have to find the right avenues to make money and be creative and being willing to flip strategies whenever you need to.
That makes sense.
I feel like private money, you asked the question, what defines private money? And you gave a really good explanation. Like there's the rich friend or rich influencer who will do that kind of note. It seems like they look for, and yourself, private lending options, look for more shorter term investments. Is that like pretty fair to say?
For the most part, I think for us, like I said, a lot of our financing is a lot of our clients aren't trying to hit home runs with these deals. They're trying to consistently get singles and doubles, make, 30 to 80K a deal and just keep it rolling while not taking on too much of a risk profile. For us, technically, we could do a year-long loan. It just gets increasingly expensive. I think one thing that really differentiates us from, the rich influencer or aunt or uncle or whoever it is we have to raise money, then we have to make spread on top of that. The rich aunt and uncle, they don't necessarily know the process of how to record a mortgage or have a lien or any of that stuff. And we work with a lot of people, even that have that kind of financing available, but that financing is not endless. At a certain point, they're going to be like, we're capped. So anybody I talk to that has it, I'm like, use that as much as possible. And then when they're out, come to us and we'll help out. I'd probably say the majority of the reason that people want to work with us when it comes to like that kind of sense is just because they get so burnt out with the bureaucratic process of the other financing parts. It's just when it's the difference of, let's say, $3,000 to $4,000 a deal when your spread on the deal is already $50K, so not even like 10% of your profit or whatever, but you're like, I don't even want to think about it.
My life's way easier.
My life is so much easier. I don't have to work on this. Like, it's just going to be done. It allows you to also scale and build your operation. But obviously there's opportunity costs there. It's inherently more expensive. You got to pay for, ease, right?
Yes.
Yeah. Rocky, I think we'd love to get a little bit more into kind of even deal by deal. Would love to hear maybe one you're doing right now and help folks understand, just for the average Joe looking in Northwest Arkansas, you guys are breaking into this market, looking to buy a flip. Maybe they found a single family home that they want to flip. They're buying it for a good price. Sure. What does that look like for them? What should they expect?
The whole process?
Total? Yeah, I'd love to know that.
It's very easy. It just comes over in the form of an email. Talk to one of our sales guys on the phone and they can collect all the data from you. We need the purchase price, the address, the estimated construction. The anticipated ARV with comps is super helpful. From there, we just do a quick initial underwrite. We're not even going to ask for financial documentation yet. Let us just put our nose to the grindstone, figure out what we think about the property, ask you questions. Is there any addition to bed bath, any addition to square footage? Are you changing the floor plan? Just getting a general idea of the strategy. I think one thing that gets really lost on people when they send over deals is they just send like 4 items and they're like, here it is. I'm like, it's fine. I'm gonna have to assume a lot of things here. I assume things, it's tough, but maybe 2 to 3 sentences of what your overall plan is. Like, the contractor's gonna come in, we're gonna tear out the carpet, put in floors. That's all super helpful. Once we do an initial underwrite on Mondays, Wednesdays, and Fridays, me and my 2 partners meet for a loan committee meeting. We'll rubber stamp the deal. So we'll say, pending financials, this deal is approved. 100% financing, whatever we're willing to give on it. So now we go back to the investor and say, hey, we're willing to give you 100% of purchase and 100% of rehab, pending you sending over your financials. The base level financials we ask for is a personal financial statement. Some people have them, some people don't. Completely fine. We can send over a skeleton. Takes 5 minutes to fill out. It's just assets and liabilities. Schedule, owned and sold. Right? The only other document we request is a tax return. That's our only legal document we need. Got to prove you're a real person. We don't get too worried about a bunch of the stuff on there. It's just, we need to show you filed that, the IRS isn't going to come and try to lean up a bunch of stuff on you. That's really it. We'll do a soft credit pull. We don't want to affect anyone's credit score. I don't understand why hard money companies do hard credit pulls. It gives you the same exact document. I've seen it. There's nothing different about the documents. And the main thing that we will look at on credit reports, just to be very transparent, is, of course, like one of my business partners says this amazingly. He started lending in 2009 or 2010. He said he'd way rather work with the guy in 2013 that had the 480 credit score that just filed for bankruptcy than the guy then that had a 780 credit score but filed for bankruptcy in 2008. He goes, one of those guys gave up right away. The other tried to claw his way out of it for 5 years. He's like, that guy has fight. This other guy didn't. He's like, so when you look at a credit score, it's very subjective. So we don't get too much in the minutia of that. I mean, we have clients who we've done 20 deals with who has a 512 credit score.
That's crazy.
His wife had cancer and he went into severe medical debt. And just like,
that's life.
Right. Their life events happen and we're not going to penalize you for that. However, Sometimes we look at credit reports of a guy with a 680 credit score, but he's missed his last 3 mortgage payments.
Yeah.
Like, listen, if you're not going to pay for where you sleep at night,
This doesn't mean that to you.
right? So there's other things that we have to look at. So looking at just a number is not necessarily the best way to analyze a person's ability to repay you.
Again, thank you guys for tuning in. I'm going to go ahead and list some sponsors off here. We're going to start with Windstone Private Lending. This episode is brought to you by Windstone Private Lending, one of the top private and hard money lenders now serving Northwest Arkansas. Whether you need short-term capital for a flip, a bridge loan, or creative financing, they've got you covered with very flexible products to fit nearly any deal, including 100% financing. What sets them apart is their deep expertise, fast response times, and ability to think outside of the box to help investors like us close quickly and efficiently. If you're looking for a real lending partner, check out Windstone Private Lending. Link is in the show notes. Our next sponsor is from Flat Branch Mortgage, specifically Colton Kennedy. Colton and I personally do business together, and he's a wonderful lender here in the Northwest Arkansas corridor. Want to invest in real estate or purchase a home, but feel like you need a secret decoder ring to understand the process? You're not alone. First-time investors, house hackers, and future homeowners, Colton Kennedy has you covered. Colton Kennedy with Flat Branch Home Loans helps people like you break into the real estate market without the guesswork. Think of him as your mortgage strategist, helping you turn "I wish I could" into "I just did." You bring the vision, he'll bring the lending game plan. Let's make your first investment a smart one. Colton Kennedy with Flat Branch Home Loans. Contact him today by calling 417-437-0086 or emailing C as in cat, K as in Kimberly, ENNEDY at Flat Branch Home Loans. That's FBHL.com. That's 417-437-0086 or emailing CKENNEDY at FBHL.com. Thank you so much, Colton. So our next sponsorship is 1440 Photography. 1440 Photography is a local company here. I love getting local companies to sponsor this podcast. They're local. They do great service, and personally, I can speak that they do a great job on mine and my clients' stuff. If you're an investor or agent in Northwest Arkansas, you need 1440 Real Estate Media in your corner. They're not just photographers. They're real estate market experts, and it's the only thing they do. MLS photos, drone, video, Matterport, whatever your listing needs, they've got it. Everything is a la carte, and it's totally customizable. And here's the best part. Just book online whenever works for you. They confirm and show up ready to go. Fast, easy, done. Where quality meets speed. Book now at 1440photography.com. Our next sponsor is Advantage Title and Escrow. They're a local company. They do great work. Specifically, Kayla Phillips. I can speak personally on this sponsor because I use Kayla for all of my transactions. It's been 2, 3, 4 years now, and Kayla and I have done a ton of deals. We probably do between 65 to 80 deals a year together, and they do a great job. The SOPs, so systems and processing that they have over Advantage Title, is just incredible. Clients love it. They do a great job from start to end communicating. When I give a deal to Advantage Title and Escrow, I know that it's going to be taken care of. There's no second guessing. I almost am able to treat them like a second transaction coordinator to my transaction coordinator that I already have. I know that they're going to handle the systems and processes correctly. As an agent, as a homeowner, as a buyer or seller, they do an incredible job of handling a transaction and communicating throughout the process. They do a great job with communication, especially Kayla Phillips over there. I would highly encourage you, if you're looking to close on a home, buy a home, if you're an agent listening, to use Advantage Title and Escrow, specifically Kayla Phillips. So you're going to reach Kayla best at 501-358-1601, or you can email her, Kayla, Cayla, at goadvantagetitle.com. Advantage is ADVANTAGE title.com. Our next sponsor is TDSIT. That's T as in Tim, D as in document, S as in solution, I as in information, T as in technology. This one hits personal. It's close to home. My dad, Tim Stanley, runs TDSIT, and he decided to sponsor our podcast. So I can speak from personal experience. I've been able to work for my dad in the past as well. And they're a great solution for business technology. If you're a local business owner or even out of state, if you're running a business, need printers, need information IT services, if you need phones, scanners, printers, all the way up to, you're printing books to, hey, we just need something in the office. TDSIT is that spot. They provide the best in-brand business technology with proven, best in local service, and they can prove it.
Special thanks to one of our sponsors who I've worked with personally on multifamily commercial loans as well as business acquisitions. People's Bank works with entrepreneurs, investors, deal makers, and risk takers. They're the ones who see opportunities where others see obstacles. Whether it's a vacant lot with a plan for a thriving business or making an old space new, they work with creators who think big and are not satisfied with the status quo. People's Bank helps you build Arkansas deal by deal and brick by brick. They don't just see numbers on a spreadsheet. They see your passion and vision. People's Bank. It's where people come first. Member FDIC. If you're needing loan assistance, reach out to Dakota at 870-883-1706 or DHEDDEN at peoplesbankar.com.
If you enjoyed the show, make sure to give us a follow on your favorite podcast platform so you never miss an update.
Don't forget to connect with us on Instagram, Facebook, and LinkedIn for more real estate insights and behind-the-scenes content.
Have a question you want us to cover? Send it our way. And if you're interested in sponsoring the show, visit nwainvesting.com to get in touch. Thanks for listening, and we'll see you next time.